There are several ways to generate income from stocks. Dividends. Some companies pay dividends to their shareholders, which are a portion of the company's profits. By owning stocks of these companies, you can earn regular income through dividend payments. Capital gains. If you buy stocks at a lower price and sell them at a higher price, you can earn capital gains. However, capital gains are not a regular income stream and are subject to market fluctuations. Covered calls. You can sell call options on the stocks you own, which will give the buyer the right to buy your stocks at a predetermined price within a certain time frame. In exchange for selling the call option, you will receive a premium, which can provide an additional income stream. Stock trading. You can buy and sell stocks frequently to take advantage of short-term price movements. However, stock trading can be risky and requires a lot of knowledge and experience. To start buying stocks, you will need to follow these steps. Open a brokerage account. You will need to open a brokerage account with a reputable brokerage firm. You can choose from a variety of brokerage options, including online brokers, full-service brokers, or robo-advisors. It's important to research and compare different brokerage firms to find one that suits your investment goals, trading style, and budget. Fund your account. Once you have opened a brokerage account, you will need to fund it by transferring money from your bank account. Most brokerage firms offer multiple funding options, including wire transfers, ACH transfers, or check deposits. Research and choose stocks. Before buying any stocks, it's important to do your research and choose stocks that align with your investment goals and risk tolerance. You can research stocks by analyzing financial statements, market trends, industry reports, and other sources of information. Place your order. Once you have chosen the stocks you want to buy, you can place your order through your brokerage account. You will need to specify the number of shares you want to buy and the price you are willing to pay. You can use several types of orders, including market orders, limit orders, and stop orders. Monitor your investments. After buying stocks, it's important to monitor your investments regularly and adjust your portfolio as needed based on changing market conditions. This can involve reviewing financial statements, keeping up with industry trends, and staying informed about any news or events that could impact your investments. Investing in stocks carries several risks, including market risk. This is the risk that the overall stock market will decline, affecting the value of your investments. This risk can be mitigated by diversifying your portfolio across different industries and asset classes. Company risk. This is the risk that a specific company's stock price will decline due to poor performance or financial difficulties. This risk can be mitigated by researching the company's financial statements, management team, and overall industry trends before investing. Interest rate risk. This is the risk that interest rates will rise, which can negatively impact stock prices. This risk can be mitigated by investing in stocks with a history of performing well in rising interest rate environments, such as utility or consumer staple stocks. Inflation risk. This is the risk that inflation will erode the purchasing power of your investments over time. This risk can be mitigated by investing in stocks that have historically outperformed inflation, such as growth stocks or stocks of companies with pricing power. Liquidity risk. This is the risk that you won't be able to sell your stocks when you need to, or at a price you desire. This risk can be mitigated by investing in stocks with high trading volumes and keeping a portion of your portfolio in cash or other highly liquid assets. To mitigate these risks, it's important to have a well-diversified portfolio, regularly review and adjust your investments based on changing market conditions, and have a long-term investment strategy that aligns with your financial goals and risk tolerance. Additionally, consulting with a financial advisor can help you make informed investment decisions and manage risk effectively. Diversifying your portfolio can help to reduce risk. By investing in a variety of different stocks from different industries, asset classes, and geographic regions, you can spread your investment risk across multiple companies and sectors. This means that if one particular company or industry performs poorly, it will not necessarily have a significant impact on your entire portfolio. Diversification can be achieved in several ways, such as investing in mutual funds, exchange-traded funds, ETFs, or index funds that track broad market indices. These investment vehicles offer exposure to a wide range of stocks, providing diversification benefits while reducing the risk of investing in individual stocks. However, it's important to note that diversification does not eliminate all investment risks. Even a well-diversified portfolio is still subject to market risk, interest rate risk, inflation risk, and other factors that can affect the overall value of your investments. It's important to have a comprehensive understanding of your investments, your financial goals, and your risk tolerance when constructing a diversified portfolio. Additionally, Regularly reviewing and adjusting your portfolio based on changing market conditions is essential to maintaining diversification and managing risk effectively.